Please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Welcome back. Well, in earnings today, Vedanta will be reporting their numbers. Nigel, what can we expect?
Well, for Vedanta, you need to keep in mind that they hold a stake in Hindustan Zinc, so bulk of the profitability is already in the price. Now, in terms of numbers, you're expecting a growth in terms of top line, margin expansion as well will be there. And in fact, profit number is expected at around 2,070 odd crores. We'll keep an eye out on depreciation. That could come in higher, and that explains why we're seeing could see a bit of a degrowth in terms of the profitability. But telling you about Hindustan Zinc, well, they hold nearly around 65% stake in Hindustan Zinc, and nearly around 50% of the EBIT comes in from Hindustan Zinc. Remember, the results are already out of Hindustan Zinc. It was a bit of a miss, so that's already in the price. What are the factors you need to watch out for? Vedanta will benefit because commodity prices have moved up at certain facilities, like particularly the aluminium facility. Volumes as well will come in higher out there. Crude prices have moved up, so that's what will help the oil and gas business. What doesn't help is there's a shutdown of copper smelting. That's what's going to hurt them, and also shutdown of Goa iron ore operations as well. There the fixed costs will continue, but otherwise, in fact, there's no real revenue coming in there. So that's what will hamper their performance. Oil and gas, that'll be the star. But let's start off with the base metal prices first. That's seen a good jump on a year-on-year basis. All base metal prices up between 10 to around 25% odd. So that's what will support the earnings. Now let's break it up. Yeah? And for Vedanta, you can't look at it on the whole, the numbers. You can't really just look at the numbers and react. You'll have to look at every segment. So let's start off with aluminium. Over there, the EBITDA expected, I was looking at a range, it's roughly around 850 to around 1,100 crores. So something around 1,000 crores, that'll be more or less in line with what the street is working with. LME prices are higher, volumes as well are higher. What they get hit on is because coal prices have moved up, and also alumina, that's a raw material for them, those prices as well have moved up. Shifting focus then to the power business, over there they're expected to deliver an EBITDA number of around 430 crores approximately. But what's going to drive the numbers is the oil and gas business. So that's going to really perform and drive these numbers. The EBITDA number is expected at around 2,000 crores approximately. Higher oil prices, higher volumes as well. And Zinc International, well, we'll keep an eye out on that one as well.
Okay, all right, Nigel. Thanks very much for that. But let's go across to Sonal now. She joins in this morning to tell us what the expectations from UPL are. Sonal.
Good morning, Ekta. Well, we're expecting good set of numbers from UPL this time around. A revenue growth of 11% would imply revenues of around 4,121 crore rupees. EBITDA is also expected to grow around the same levels, up 10% at 831 crore rupees. However, EBITDA margins, they are expected to stay flat because of higher other operating costs. PAT also is expected to go up by around 9% at around 520 crore rupees. Now, majorly, this revenue growth will be driven by higher domestic share, and it will be driven by the Indian markets, where we are expecting a revenue growth of around 11% on the back of normal monsoon expectation. Brazil, on the other hand, which is also a major source of revenue, there we are expecting revenue growth ranging from 0 to 2%. That was majorly because Brazilian real, that had depreciated quite a bit in the last quarter. The other geographies like North America and rest of the world are expected to grow at around 7%. Europe also is one of the major markets, and there we are expecting a growth of around 8%. So overall, the volume growth is expected at around 7%, and Kotak is expecting a hike in prices at around 1%, and also growth will be driven by cross-currency movements. While there are a lot of adjustments in this results, majorly led by the forex gains or losses, a lot of brokerages this time are factoring in no forex gain or loss, so we'll look out for that, and stock will be in focus today. Back to you.
All right, thanks so much for that, Sonal. I'll take care of that cough, I think. But let's go across to Anisha. She's here. I think she's going to tell us about Power Grid. Anisha.
Well, yes, Nigel. Good morning. Thank you so much for that. Well, we're used to a steady quarter from Power Grid, and that is what is expected. We're looking at the top line growth of around 14%. The margins are expected to stay stable around that 86% mark, and the profits are expected to go up by around 8%. A tad bit slower growth when it comes to the PAT, because the other income is expected to go down for the company. Other than that, the capitalization has been really strong in the last 12 months, and that is what is expected to drive the top line growth. With Power Grid, remember the key number numbers to watch out for is capitalization as well as the capex in the quarter. We are expecting a number of around 3,500 to 5,000 crores when it comes to the capitalization, as well as commissioning of around 6,000 odd crores. But do remember, apart from the numbers, the management commentary is going to be very important, because remember, the draft tariff policy is just around the corner. The street will be watching out what is the regulated equity they're allowed to make in the next round of 5 years or not. Other than that, a lot of the street believes that the capitalization has actually peaked. So the management commentary on that will be important. So let's watch out for those numbers, expected to be a steady set.
Okay, all right, Anisha, thanks very much for that. Well, let's go across to Mangalam now, who joins in with an update on what we can expect on Dabur.
Well, Ekta, for Dabur, the stock has risen about 30% over the last 12 months. Currently trades at 37 times FY20 earnings, which means that it is still at a bit of a discount to the other stocks in the sector. For them, there are 4 positive triggers this quarter. The first one, of course, good results expected on a low base. In the base quarter, we saw a volume decline of close to 4.5%. Add to that, there is recovery in both the rural as well as international business, the Middle East, North Africa region, where we are seeing crude price impact, aid sentiment out there. Add to that, we have the company gaining some market share in oral care due to its new launches. And fourthly, the competitive intensity from Patanjali is reducing. So add all these things together, we get a total income growth of around 13%. That's exactly what the poll is throwing up, close to around 2,017 crores on the top line. The margins are likely to expand by about 200 basis points. 19.2% is what the poll is pegging the EBITDA margins for Dabur to be at. And on the back of that, the net profit is likely to grow by 27%. The key number out there is close to around 336 crores. The domestic volume growth on the back of a low base is seen between 12 to 14%. Some part of the street is also expecting 15% and higher. So that is something we will keep an eye out on. In individual segments, definitely watch out for what their oral care and toothpaste business is doing, because over the last 3 quarters, we have seen a lot of traction in both the segments. And finally, the international business, Middle East and North African regions showing some recovery. That accounts for about 25-30% of their overall revenue international business. We'll see whether there is recovery out there or not.
Okay, all right, Mangalam, thanks so much for that. Well, let's hop across to Reema. She's standing by. She's going to tell us about Tech Mahindra. We'll be reacting to its numbers. Hey, Reema, good morning.
Hi Nigel, good morning. Well, I expect a positive reaction for Tech Mahindra because in the last 1 or 2 months, the stock has corrected nearly 15% from its peak levels and the numbers were better than muted expectation, and even the management commentary suggested that the outlook is a bit optimistic. So first, the dollar revenue has come down by 1.6% on a quarter-on-quarter basis in line with expectations, but the constant currency growth at 0.3% is better than what the street was anticipating. The street was expecting the constant currency to decline. With respect to margins have come down by 80 basis points to 13%, but that too was better than expectation because the street was expecting nearly a 150 basis points decline. The key reason why the margin is declined, one, on account of the weakness at Comviva on account of seasonality. Apart from that, you also had visa costs, wage hikes, which negatively impacted them, and this is only partly offset because of a rupee depreciation and productivity gains. With respect, to the profitability, profits have come largely in line with expectation. Telecom continues to remain a weak spot for Tech Mahindra. So telecom dollar revenues had declined by 6.5% on a quarter-on-quarter basis, impacted because of seasonality at Comviva as well as cross-currency headwinds. If you exclude that, telecom revenues were down 1% on a constant currency basis. So growth was led by the non-telecom business, so the enterprise vertical, which saw about a 3.8% growth on a quarter-on-quarter basis. Kotak says the outlook remains promising on the back of new deal closures in the telecom vertical and sustained revenue momentum in the enterprise segment. CLSA has upgraded the stock to an underperform from a sell rating. They say limiting the margin slide to 80 basis points was an unexpected positive, which shows signs of process maturity. However, incremental margin levers from here on stay dependent on the overall growth trajectory. So on the whole, better than muted expectations.
Okay, and Reema, idea?
Very disappointing operational performance, Ekta. So the EBITDA margins for Idea have come in at 11.2% versus expectations of 14%. And if you look at the margin trajectory in the last 4 years, it's fallen from levels of 36-37% and now down to 11%. Even the revenues, if you adjust it for the loss of revenues in account of the sale of the standalone towers has declined by 2.9%, and you compare that to peers. So Bharti had a wireless India revenue growth of 1.2%, while Vodafone had a decline of 1.4%. So even on that front, its performance was weaker than that of peers. If you look at the bottom line, yes, we were expecting a 1,500 crore loss. This time the companies reported a profit of more than 250 crore, but that is largely on account of exceptional gains. Their balance sheet also remains quite weak. So the debt is at about 50,000 crore rupees, and if you do the net debt to the quarterly annualized EBITDA, then you're getting a figure of 19 times. Capex at 980 crores in the quarter was also lower than that of peers. So Bharti had a capex of about 8,000 crores, while Jio had it 17,000 crore rupees. And not just that, the companies also lost subscribers to the tune of 6.6 million in the quarter. So on the whole, it's a weak performance by Idea.
Let's shift focus on the equity markets, the commodity markets. Manisha joins us early this morning to tell us what's going on there. Hey Manisha, good morning.
Hi, morning, and thank you so much for that. Let's start with the crude oil prices, where we saw 2% gains yesterday, but that doesn't seem to be holding up in the Tuesday Asian markets right now, and that is after the report that the OPEC production is at a 2018 highs, increased by 70,000 barrels per day to 32.64, which is the 2018 highs. So that is what has pulled the prices down. But you haven't seen a complete sell-off, and that is because the global inventory picture also seems bullish. Where we had inventories in 2017, the markets clearly are off those kind of highs. Also, there are concerns from the outage at Syncrude at Canada. That would mean that the Canadian exports to U.S. in sense of crude oil also may have declined. So these are a couple of factors which will continue to give some support to the crude oil prices. Another number to watch out or digest today really is the Chinese PMI manufacturing numbers. Those definitely are less than what the street was expecting with, and you will see an impact of that on the asset classes.
Okay, all right, Manisha. Thanks very much for that. Let's go across to Manglam now. He joins in with cues from the F&O space. Manglam.
Well, morning, Ekta. I was looking at the FII flows yesterday. They sold about 200 plus crores in the cash market. Similar was the sell that they sell figure that came in index futures. However, the stock futures out there, the purchase of 1,000 crores actually more than outdoes what the sale in stock in cash market as well as index futures did. So perhaps there is some hedging taking place. The FIs are buying in stock futures and at the same time hedging their positions in the cash market as well as index futures. The index futures sell number as well, not too alarming because remember we are at record highs and there was nearly one long position added for a short position as well, and the FIIs are already 58% long in index futures. Index options data positive for second day in a row. The foreign institutional investors are adding long calls, bracing themselves for an up move, as well as adding short puts. In the last two trading sessions, they've added close to around 30,000 short puts. That's telling you that a strong support is seen at the bottom. And while the Nifty conquered the 11,300 mark yesterday, the 11,300 put saw some writing, was fairly active, 4 lakh shares for a premium of around 130 rupees. That's telling you 11,200 thereabouts could be a support. 11,200 put itself added close to around 3.5 lakh shares too. 11,600 call on the upside was fairly active, so that is one strike we will keep on our radar. And ICICI Bank, a lot of long positions added there.